This video deals with one of the 5 capital budgeting techniques that we're going to cover in this course. The 5 techniques are net present value, internal rate of return, profitability index, the payback period, and what's called the modified internal rate of return. Now the first one we're going to talk about now, this is one of the better known capital budgeting techniques. It's called net present value. And as a definition now, net present value is the present value of the inflows minus the present value of the outflows. Now, when we talk about inflows and outflows, we're talking about, with the inflows, cash inflows. And at some point you'll learn how to calculate cash inflows and the cash flows of a project. The present value of the outflows, we talked about this in an earlier video, the present value of the outflows is the initial investment in the project. Now, when you calculate net present value, the answer you get is in a dollar format. So you'll get a number like $40,000 or negative, $75,000. But it'll be in a dollar format. The decision criteria with net present value is that if the net present value is positive, you accept the project. If it's negative, you reject the project. Now, earlier we talked about the normative objective function of the financial manager, which is to maximize shareholder wealth given some level of risk. Now, shareholder wealth, the value of the firm, the price of the stock in the market, those are all the same thing. If we had a project where our net present value that we calculated now was a positive $70,000, indeed, that would mean that we want to accept the project. Financially, what it means now is that if we accept the project, we would be adding $70,000 to the value of the firm. And if you divided that by the number of shares outstanding, that would tell you how much you would add to the intrinsic value of each share of stock. So when we look at net present value, lots of finance people like net present value because it gives them an idea of how much value they're adding to the firm and to the wealth of the shareholder. Would we ever accept a negative net present value project? Well, no, we wouldn't do that consciously at any rate. But remember, this is all, we're trying to make decisions about what projects to invest in. Now, we're not talking about projects that we've already invested in. We're talking about potential projects here. So if the net present value is positive, you would accept the project. If it's negative, you reject the project. Now, with net present value, there are 2 key assumptions that we make with net present value. One assumption is that all cash flows are reinvested. Now, this means that if you had a project that was going to produce cash inflows of $20,000 a year for 10 years, that means that one of the key assumptions to accepting that project and expecting the positive net present value to occur means that you would have to reinvest that $20,000 every year for 10 years. If you didn't do that in one of the years, you decided to go on vacation and spend the money or what have you, if you didn't do that, you'd get a net present value, but it'd be less than the present value that you originally calculated. So if the project you're talking about had a net present value of $70,000 and you didn't reinvest one of the cash flows, the result of that would be a reduced net present value for that project. So you wouldn't see the financial consequence of that project. One of the other key assumptions with net present value is not only that you reinvest all the cash flows, but that you reinvest them somewhere to earn the firm's weighted average cost of capital. Again, if you don't earn the cost of capital on all the reinvested money, yes, you'll get a net present value, and it may be positive, but it's going to be a reduced net present value. On the other hand, if you could reinvest all the cash flows and earn a return greater than the cost of capital, then you would end up realizing a net present value that is greater than you originally calculated. But this is net present value, and this is one of the 5 capital budgeting techniques we're going to talk about. And And in the next video, we're going to talk about the internal rate of return technique.